Welcome to Talk Tickers. Today, we are digging into Hawaiian Electric's third quarter 2025 earnings call. And let me tell you, there's a really interesting story behind these numbers.
All right, so let's get right into it, because what we have here is, well, it's a classic Wall Street puzzle. You've got the headline saying one thing, a solid earnings beat, but then you look at the tape and the stock is selling off. So what gives? That disconnect is really the whole story here. So let's unpack what spooked the market.
Okay, first up, results versus the tape. We're talking a positive print that got a pretty negative reaction.
And look, the numbers themselves, they were good. No two ways about it. Core EPS came in at 19 cents when the street was only looking for 18. That's a solid 5.6% surprise. I mean, that is a clean, clear beat. But did that beat matter? Not at all. In fact, the stock did the complete opposite of what you'd expect. It closed at $11.57 before the report, and the very next day, bam, it drops over 3% to $11.20. And notice that, it was on high volume. That's the market telling us loud and clear, we don't care about this quarter's numbers, we're worried about something else.
So now we get to the de-risking story. This is all about management's focus on operational progress and, getting their financial house in order. And what's so fascinating is that management spent almost the entire call trying to tell this story of progress. They were really trying to paint a picture of a stronger, de-risked company. And they laid out this really clear three-step playbook. Step 1, they've got their new wildfire tech. We're talking AI cameras, weather stations, actually deployed ahead of schedule. That's a big win. Step 2, that big settlement, it's moving along just fine through the courts, right on track. And Step 3, they've been very busy strengthening their liquidity. And this is how they're doing it. They just completed a massive $500 million debt offering. On top of that, they expanded their credit facility by another $225 million. You add it all up, and they've built up a really solid cash cushion. It shows the market, hey, we can still raise money when we need to. Okay, so everything sounds pretty good so far, right? Well, this next part, this is where the anxiety starts to creep in. Let's talk about guidance and the big spend, because the cost of building this more resilient utility, well, it's huge. So management drops this number on the call, $2.4 billion. That's the potential capital expenditure over the next 3 years. Just let that sink in. That is the number that made investors sit up and take notice. And if you look at how it breaks down, you can see this spending is really back-end loaded. It starts with about $400 million in 2025, but then it just explodes in 2026 and beyond. All of this cash is going towards essential stuff, wildfire safety, making the grid more reliable, new power generation. It's all stuff they have to do, but man, is it expensive. And here's the kicker. That giant spending plan, it's completely tied to them getting through what you could call a regulatory gauntlet. It's a whole series of hurdles. Look at these dates in early 2026. January 7th, they have to file their big proposal with the PUC. The very next day, a court hearing on the settlement. Everything rides on these dates. This is where they find out if they'll actually be allowed to get this money back from their customers. Which, of course, brings us back to the investor view and how to read between the lines of what the market is doing. So why the disconnect? Why did the stock fall after a solid quarter? Simple. The market is always looking ahead, and it's pricing in all the huge risks that are still out there. Here's what the market is really worried about. Forget the Q3 beat. Investors are laser-focused on these huge unanswered questions. First, future dilution. How in the world are they going to pay for $2.4 billion? Will they have to issue a ton of new stock and crush existing shareholders? Second, regulatory outcomes. Is the PUC going to give them what they need? It's a total unknown. And finally, settlement funding. On top of all that spending, how are they going to fund the rest of the settlement payments? These aren't just small questions. These are the billion-dollar overhangs on the stock. All right, so putting all the pieces together, let's get to the next call. Here's our take on HEI and where it goes from here. So where does HEI go from here? Look, this company is walking a tightrope. On one side, you have genuine, solid progress. They are absolutely executing on their de-risking plan. But on the other side, you have this mountain of future spending and all those regulatory hurdles we just talked about. So for us, the call is market perform. We love what management is doing on the operational side. That's a huge positive. But it's just completely canceled out by this massive, uncertain capital plan. Until we get real clarity on how that $2.4 billion is getting funded and, crucially, getting recovered in their rates, we think the stock is stuck. It's likely just going to trade sideways. So for the next quarter, don't watch the earnings number, watch the regulatory filings. That's where the real story is.
And as always, we have to say it, this is not financial advice.